What if I told you there was a way to take the returns of the stock market and just multiply them, turning a really good year into a genuinely life-changing one? Well, that's the incredible promise of something called leveraged ETFs. But as we're about to find out, this high-stakes gamble has a story that is way, way more complicated than it looks on the surface. Just look at this number for a second. No, that is not a typo. That is the actual total return of a single investment, the ProShares Ultra Pro QQQ, or TQQQ for short, since it first launched back in February 2010. It is just an absolutely staggering figure that hints at almost unbelievable wealth. And to really put that into perspective, check this out. Let's say you invested 10 grand into the standard NASDAQ 100 ETF, which is QQQ. You'd have done great. You'd have over $163,000. Awesome. But if you had put that same $10,000 into its 3x leveraged coven, TQQQ, it would have exploded into more than $2.6 million. Seeing a chart like that, there's really only one question that comes to mind, right? Why isn't every single long-term investor on the planet just doing this? I mean, if the returns are that astronomical, what's the catch? And trust me, there is a very, very big catch. It turns out lurking just behind those mind-blowing returns is this huge chorus of warnings. And it's coming from everyone, from the fund issuers themselves, all the way down to everyday investors who have been seriously burned. The message is crystal clear. These are not your typical buy and hold investments. So let's start with the official fine print. ProShares, the actual company that makes TQQQ, puts this warning right on their website. And the key phrase to zero in on here is daily returns. You see, these funds are engineered to give you 3 times the performance of the NASDAQ 100, but only for a single day. The second you hold them any longer than that, the math starts to get, well, it gets weird. And here's what that weird math can feel like in the real world. This Reddit user just puts it so bluntly. A 90% plus loss isn't some abstract risk. It's a very real thing that can happen in a downturn. And trying to dig yourself out of a hole that deep is, as they say, mathematically brutal. So why? Why does this happen? Okay, let's dive into the mechanics of this, because the answer lies in this really powerful but often misunderstood concept called volatility drag. You can think of this as the hidden villain of our story. It's a cost that doesn't show up on any expense report, but it can absolutely demolish your returns. So here's the best way to think about it. Every time your investment goes up and down, it's like you're trying to run up a down escalator. The more the escalator moves, the harder you have to run just to stay in the same place. That's volatility drag. It's this damaging gap between what a simple average of your returns might suggest and the actual lower amount of money that ends up in your account thanks to the harsh reality of compounding. And this simple chart just illustrates the point perfectly. Imagine the market drops 10% one day and then gains 10% the next. The simple average return is 0, so you broke even, right? Nope, wrong. The geometric return, which is how your money actually grows, shows a 1% loss. Your $100 became 90, and then that $90 only grew back to 99. You lost $1 just from the volatility. That's the drag. Now here is the absolute kicker. Leverage acts like a massive amplifier for that drag. It pours gasoline on the fire. As this chart shows, if you take a volatile asset and you slap 2x leverage on it, you don't just double the drag, you can actually quadruple it. That little 1% loss we just saw can spiral into something much, much worse, really fast. So, okay, let's move away from the theory for a second and see how this actually plays out with real assets. Because this isn't just some mathematical curiosity. It has dramatic real-world consequences for investors. This is a fascinating and totally counterintuitive example. MicroStrategy, the ticker MSTR, is a famously volatile stock that has also performed incredibly well. So you'd think, hey, let's apply 2x leverage and supercharge those returns. But because its volatility was so extreme, the drag was absolutely brutal. A modeled 2x leveraged version of the stock actually produced an annualized return that was half of the unleveraged one. Think about that. More risk for far, far less reward. And this is what it looks like when a real storm hits. In the 2022 bear market, the regular QQQ dropped about 33%. Now, if things were simple, you'd expect the 3x leveraged TQQQ to drop about 99% over the year. But it was worse. The daily compounding of all those losses resulted in a catastrophic 79% wipeout. It's just a brutal demonstration of how volatility drag punishes you the most when the market is already kicking you. So, this brings us right back to our initial puzzle. I mean, if volatility drag is this destructive, how on earth did TQQQ produce that insane 26,000% return we saw at the beginning? Is it even possible for the sheer force of high returns to just muscle through the drag over the long term? So that's the crucial question, right? Is long-term success with these things just a total fluke? Was it just an anomaly of one of the greatest bull runs in history? Or is there actually a mathematical reason it can sometimes work out? Well, academic research actually gives us a pretty clear answer. Long-term success isn't impossible, but it is highly conditional. It all hinges on this really delicate balance. The underlying asset's returns have to be consistently high enough, and its volatility has to be consistently low enough to basically outrun the constant grinding effect of volatility drag. It's a tightrope walk. And the research actually puts some hard numbers on this. For a 2x leveraged S&P 500 ETFs to win in the long run, you're basically betting that the market will stay inside this very narrow performance window. Returns have to be high, and volatility has to stay unusually low. So it's not just a bet on the market going up, it's a bet on it going up smoothly, without a lot of bumps. So let's just boil this all down. What are the key takeaways here? 1. Yes, the potential for massive, life-changing returns is absolutely real, but it is handcuffed to extreme, amplified risk. 2. That risk is driven by volatility drag, which is a mathematical certainty that just eats away at your money in choppy or sideways markets. 3. This drag causes absolutely catastrophic losses during downturns, often way worse than the leverage multiple would suggest. And finally, 4. For this strategy to actually work long-term, you need a very specific kind of future, a sustained, powerful, and relatively smooth bull market. And that really leaves us with the final question, which is a personal one for every investor. Now that you understand the mechanics, the math, the whole trade-off, you have to decide for yourself. Is the potential for that extraordinary reward worth taking on an amplified and often hidden risk?